Well, I'm delighted today to be speaking with Sam Faulkner, who's a co-founder of Sire Capital Partners. We're going to be talking about the new business that's been set up, as well as the latest trends from the real estate market. Welcome, Sam.
Thanks, David.
So looking forward to discussing some of the latest trends from the real estate market. But first of all, Sire Capital Partners, it's a new business you've set up. Perhaps you could tell us a little bit more about it.
Yeah, so really excited to be starting with Sire Capital Partners this year. I've come out of a really institutional-focused investment background. I was working with CBRE Global Investors, or more recently called CBRE Investment Management. I think that the focus with Sire Capital Partners, which I've co-founded with Patrick, was really carrying on board that institutional investment quality advice and that investment process into a space for small to medium-sized investors. So that's really the theme that we're pushing this year, is establishing ourselves as that really high-quality advice for the small to medium-sized investor.
Fantastic. So perhaps you could just walk us through your background. I mean, you've worked around the world as well. Give us a sense of what you've done previously.
Yeah, so as you may be able to pick up from my accent, I'm not originally from London. So I was born in New Zealand and started my career in New Zealand. I actually started in a financial risk team at PricewaterhouseCoopers. I was in an actuarial team, so really quite a quantitative background, doing a lot of financial modelling for pension schemes. I then wanted to make the move into asset management. I started working for an investment consultancy in New Zealand as well called Russell Investments. There I focused on traditional asset classes, but also alternative asset classes, and had a particular interest in real estate, mainly at that stage in the listed sector. So in 2017, it's a fairly well-trodden path for Kiwis to come move to London. And so in 2017, my wife and I moved here, and I started working for CBRE Global Investors, as it was known then. And I was part of the global portfolio management team. So we were investing on behalf of large pension schemes, insurance companies, sovereign wealth funds, investing globally into really core or core plus type real estate. So I got a really good exposure to a number of different markets and sectors around the world, as well as different structures. So sometimes we'd be investing directly into a single asset, sometimes it would be into a portfolio of assets via a joint venture, perhaps a club structure, or even funds. So a really broad kind of remit to invest and create globally diversified real estate portfolios.
Because looking at the structure and potential restructuring is a big part of your value add, isn't it? So leveraging that experience to date, that's partly what you're bringing that's new to the market, if you like. Is that fair?
Yeah, I think so. I think having that familiarity with a lot of different structures and how things are done in different parts of the world is really valuable in the UK context, and it's something that we want to try and apply, to some of the asset owners and developers who are looking for more kind of creative solutions. Debt's really expensive at the moment. There's opportunity to look at different structures there as well. So
do you think the macroeconomic environment makes the requirement to look at restructuring more pressing because cost of debt rising? It's making these decisions more urgent, isn't it, for asset owners?
Yeah, I think, if you looked back a year ago, for some of these asset owners, they would have been able to get 5 to 10 term sheets from different lenders, right? Now you have to work really hard to get a single term sheet from a lender, and that's and even in the bank space and alternative finance space as well. So I think your advisors are having to work a lot harder to get you some options on the table to at least look at. So that's one thing, and then that's in the traditional debt space, and then there's sort of alternative structures that we can look at as well. And one of them, we're working with a ground rent fund who's particularly busy at the moment because they're able to offer a really low cost of capital on that ground rent. So it's switching from a freehold to a really long leasehold, 200-year plus leasehold, and it's quite a nice option for particularly operational real estate that has long-term income linked to inflation. It's quite a nice match there.
And starting any business is a challenge. I mean, perhaps you could tell us a little bit more about what challenges you faced in the past, why you think this business, why the time to start it is now, and why you plan to be in business for a long time to come.
Yeah, it's a good question. So a lot of the big agents right now are cutting brokers. And I think, being a small business, we're able to be quite nimble. We're able to focus on strategies that we see as being relevant right now and move in and out of those kind of strategies. And so I think, if we look into 2023, the real question is how are banks going to behave in terms of financing where it's meeting those covenants or breaching those covenants. So as asset valuations come down, you run into LTV limits and interest coverage ratio limits. And we saw during COVID, these kind of situations were happening and the banks were very accommodative because it was seen as a really short-term situation where landlords weren't earning rent, but those numbers were going to improve. And so the banks were lenient in terms of breaching those covenants. There's a real question in the market now about whether in 2023, particularly in the first half of 2023, how are the banks going to behave? And so when you come up to debt refinancing in the first half of the year, what are you going to be looking at? Are you going to be able to get the same level of your LTV, your loan to value ratio from the bank, or are they going to be pushing you to repay some of that debt? So perhaps you'd financed your asset with senior debt, and that was up to 50 to 60% LTV. Now the banks may be down at like 35 to 40%, and you're going to have to look for perhaps a mezzanine piece to fill up that capital stack. So where are those alternative lenders going to come from? And having that capital advisor that can give you that access to all of those different parts of the debt capital markets and also sort of non-traditional parts of financing, I think that's going to be where there's a lot of work and where your advisor can really add value next year.
And I guess where the banks are playing hardball or where things can't be restructured, it's going to create buying opportunities, I guess, for those with dry powder to look at. I mean, you can operate on both sides of the coin there, can't you? You can work with the client looking at restructuring, but also there might be opportunities to bring investors to the table that are looking for these assets if covenants can't be met.
Yeah, absolutely. So there's two sides of the business, as you say. There's sort of the capital advisory piece and also the brokerage side. And I think particularly for investors who have the cash and are buying unlevered assets at this stage, there's going to be real opportunity for them because they're a smaller pool of buyers. The levered buyers are pulled out of the market. So there's on sort of the demand side. And then on the supply side, as you say, if banks start to be a bit more strict in enforcing some of those covenants and start putting a bit more pressure on, then you could see a bit more supply side coming through. So that dynamic could be really attractive for certain buyers next year.
And the foreign investor aspect is very important there, isn't it? Because there could be buyers sat in cash in the Middle East, Far East, with dry powder looking for these distressed scenarios. So I guess it's the global picture is very important, isn't it, in the investor base there?
Yeah, absolutely. I mean, we know there's a lot of cash sitting on the sidelines waiting to get into real estate. And I think as an asset class, it's performed so well over the last 10, 15 years that I don't think strategically investors are reducing that size in their portfolio. But what they are doing is just waiting to see where valuations are going to settle out given the new and it changed really quickly in terms of debt capital market pricing. So there's got to be a change in terms of yields on real estate as well. And people are sort of playing it cautiously, waiting to see where that lands.
And in terms of looking at the different segments of the market, I mean, are there certain sectors that you see are being as more buoyant and popular? I mean, the office sector is going through great change at the moment with, work from home trends, massive shifts in behavior that we haven't seen, unprecedented shifts in behavior. I mean, what's your read on the central business district and the office market as we stand?
Yeah, I think, people were working from home for so long. We had 2.5 years of working from home that it really enforced those behaviors. It was long enough to really entrench them. And you've seen some large employers have really tried to push to get employees back into the office. And then they've faced, turnover in staff because the other company is offering, 2 days a week work from home. And that's really an incentive. is actually attractive relative to maybe a higher salary in a place that wants you in there sort of 5 days a week.
It's a tight labour market as well, isn't it? So employers are trying to be accommodating.
Exactly. So perhaps as the labour market sort of gets less tight towards the second half of next year, then maybe the employers are going to have more sort of push to get people back in the office. But from what we're seeing, there's sort of somewhere around 40 to 50% physical occupancy in office space now, which kind of relates to about 2 days to 3 days working from home, about what you would expect from that kind of dynamic. And I think what's really important is that the office offers a real experience, and there's a reason for people to come in. So what we've seen is that occupiers of office space have moved from sort of banks of desks to fewer desks, but more sort of breakout space where you can go collaborate with your colleagues, you can take Zoom calls for that sort of hybrid working. So I think, as an office owner, as an office investor, you want to think about the capex in your office. So, you've got to have a space that's nice and enjoyable, has natural light, has good end of trip facilities so people can ride their bike in, and obviously is
sustainability as well is a big feature, isn't it, of what tenants are thinking about as well right now, the use of the office. I mean, do you see that coming through in terms of the type of supply of office space?
I think ESG and sustainability might have been a nice to have 2 or 3 years ago, but now it's really sort of top or close to top of the list in terms of what occupiers want, and also what investors should be thinking about as well.
And I guess this change of need will create opportunities for developers to bring new stock into the market, to repurpose what's there. So someone's going to come in with innovation, aren't they?
Yeah.
And then that just has to be financed.
Yeah, they call it a sort of a brown to green strategy. So you take older brown buildings and reposition them. Yeah.
And for those developers who are going to seize those opportunities, I mean, what are some of the what are the 3 common mistakes you might see in people raising finance for new schemes and projects that they see opportunity for?
Yeah, I think suitability of your stakeholders in the project is really important. So you may be developing a business plan, and it may be early stages in that, and you need some flexibility as that business plan may change over time as well. So having the right stakeholders in there on the equity side and also on the debt side to allow for that flexibility that may come in the business plan as you move through it towards completion. So I think that's one of the biggest mistakes that I've seen in terms of the structure of a vehicle and the governance within that vehicle, that developers have really run into problems with not having the right capital alongside them, can cause issues there.
Are there any other things that are common issues that people will trip themselves up on, or is it a case of just finding the right partners to help you navigate these quite basic issues, as it were?
Oh, I think I talked about how coming from an institutional investment background, we'd really seen the level of scrutiny and the types of questions that would go into the investment process before making a commitment to a deal. And then if you look at some of the smaller to medium-sized investors who aren't applying that same level of scrutiny, who aren't asking those same questions, they aren't getting as clear a picture of what the economic reality of that deal is. And so I think that's where you can get help, and you can sort of draw on what an investment process looks like for an institutional investor and try and take some of that knowledge and really apply it. So obviously, being an institutional investor, if you've got a 200 million, 300 million to invest into something, you're obviously going to be able to push for better terms, and you're going to get better sort of cut through in the market than if you're in the 10 to 20 million size. So I'm not saying that you're going to be able to invest exactly like an institution, but you can take some of those concepts and ideas and really apply them in the way that you invest, in the way that you choose your investment partners as well.
And I mean, we touched on the office sector, but I mean, what are some of the other sectors of commercial property that you see are buoyant and interesting right now, not just in London, but across the UK and elsewhere? Yeah,
I think it's still really the same themes. So they've said beds and sheds has been the themes across major sort of investment managers. And I think the fundamentals in both of those sectors are still really strong. So, we've seen, let's take the logistics market, for example. We have seen a slowdown in terms of e-commerce spending, just as the cost of living crisis has hit. People are just spending less money on consumer goods. But against that, given that global supply chains have really tightened up, and these owners of warehouse space have now started onshoring. So they're starting holding more inventory closer to their consumer, so closer to London, for example. So we're seeing just a bigger warehouse footprint for those owners. So actually, even though there's been a slowdown in consumption, the take-up of warehouse space has increased just because they want to hold more inventory in country. So I think fundamentals of logistics are really strong, and there hasn't been the supply response that you would expect given how much rental growth we've seen in the sector over the last 2 years. It's just been slow to come. It's been slow to find land. Construction costs are high. Debt costs are really high. So occupier markets, really strong in logistics. But I think that it's inevitable when yields increase that much in terms of government bond yields and the cost of short-term debt, that we're not going to see a repricing in terms of capital markets, and the logistics space is simply not going to be immune to it, even if there's some nice rental growth that kind of softens that yield expansion.
And as we do move into this new phase in the economic cycle, what is it that developers and asset owners should be looking at in terms of the portfolio? Can they benefit from a fresh pair of eyes looking at the scenario they're in?
Yeah, I think absolutely they can. Like I said, if you applied to just bank lenders a year ago, you probably would have got 5 to 10 term sheets, depending on what part of the market you're in. Obviously, some parts of the market are more popular than others. Now, I think going out to traditional bank lenders, from what we're hearing, it's really hard to get a single term sheet. So, you are forced to look outside there. And so having a capital advisor that has contacts into some of those alternative lending channels or, non-traditional financing channels, I think is great. I think it's going to help you at least bring some options to the table, because you may be sitting there going, what can we do? What are the options here? So I think someone who's doing that digging for you, really sort of wearing out the shoe leather, finding those providers they're going to add real value.
And why is outsourcing of this kind of capital raising relevant and interesting rather than a developer just bringing on someone to go and explore those opportunities for themselves?
Yeah, it's a good point. And we have seen developers that build up their own capital raising team. Sometimes they have turnover in that team. Sometimes the cost of managing that team is high, particularly during times when you're not doing any transactions, because obviously that's where you're sort of making the money there. So maintaining that team can be expensive. I think doing an outsource model, which we offer, is purely success fee based. So during quiet periods where you're not doing transactions, it's not it's not an internal cost function that you're having to maintain. And also we're just able to build up that contact through the capital advisory side and the brokerage side. We have a really large investment database, and it goes all the way down from large institutions to a lot of PCD members who are high net worths, family offices, lawyers, tax advisors, and sort of gatekeepers, trustees, kind of. So it's a larger Rolodex than what they would have on their own.
Because they can leverage the fact that you're having a lot of conversations. If they're having those conversations in isolation about a single scheme, it takes a long time to build that up and broke, I guess, and find partnerships, isn't it? Is the key to it.
Precisely. Yep.
And just coming on to, I suppose, the PCD members that you might work with. Within our audience, we've got a lot of legal, tax, accounting, fiduciary sectors. Where do you see, who are the most important partners, I guess, for you in the professional services world?
Yeah, so I guess those lawyers and accountants are going to know when the asset owners who are their clients are coming up to refinance dates. And they're going to, they should want to give the best terms and give the most options to their clients as well. So those kind of people, we'd absolutely love to have an introduction to, love to speak with, and show them some of the alternatives that we can come up with through our network. So those kind of introductions would be absolutely fantastic.
So your quantitative background's very interesting. I guess that means in the relationships you have with any partner, you're seeking to add more value. You've got intellectual capital, I guess, to impart, to share with those partners. I mean, how do you see the value you can create with those in the real estate sector?
Yeah, so we offer a fully outsourced capital raising service, and we mean more than just preparing a pitch document. We can actually help with the financial modeling. We can help with some more in-depth sort of scenario analysis. All of these kind of things which we've developed, Patrick and I both coming out of actual asset management, investment management. We're able to apply those skills to help our clients in that way. And
I mean, what are some of the variables there on that modelling? I guess interest rates is a key one, the time horizon, the cash flows on the rental. I mean, what kind, if you're crunching the numbers, what sort of things are you looking at to produce something that's robust?
Yeah, so I think, typically it would have just been rental growth and what's your exit yield. So I've got a 5-year hold, what's my rental growth going to be, what's my cap rate when I exit. But I think now there's far more parts to it. So if you take on debt day one, it's quite likely that debt's not going to be accretive, right? So you're actually going to have net cash flow from day one if you're a levered buyer coming into an asset. So how long are you going to be able to maintain that in terms of modeling your cash flow? And so then you have to have a really, really clear view on what your rental growth is, what the rent roll in the portfolio is, where occupier markets are going in terms of supply and demand, and how likely it is to achieve that kind of rental growth. And then on the financing side, really starting to stress during scenario analysis in terms of where rates could go, where you want to fix, and when your next refinancing date is going to be, and what your asset is going to look like on that refi date as well. So I think the traditional scenario analysis of rental growth and exit yields is still there. It's still important. It's still fundamental. But there's just a lot of
more
other...
in a predictable environment, didn't it? Of low rates and, say, in the office world, high occupancy.
Yeah.
They were givens, weren't they? Whereas I think now the plates are shifting, aren't they?
Yeah, absolutely.